All right, good morning. Good morning, everyone. Um, Welcome to today's episode of this video. In this video, I just want to drop a detailed explanation on how I'm marking my analysis. Now, you will observe that for those who have been in the group for a long time, especially those on the practical channel, you will notice that there was a time that was, around from throughout, in fact, majorly last year and around, let's say, early this year, we are used to catching bigger peeps like 200 peeps, 300 peeps, 100 peeps, and above. But lately, it became very difficult to catch all of that. Now, I think the problem was actually from me because I made some huge losses and because I didn't follow proper risk management, and it messed up my psychology that I could not mark. I was not having that much confidence to mark in some high profitable trade. So now I've been doing a lot of work on myself and I've done some um, modification in my strategies, and I think I just want to share the modifications with you people. So first, let's discuss how I mark my analysis for yesterday. The sell I dropped on GBP USD. How did I even come about that sell? So the first thing I did, there's something I call psychology level in Forex. Psychology level. Some traders might already know what psychology levels are because I'm not the first trader who's mentioning that. So psychology levels are just random numbers in the market. For example, if you are looking at my chart now, you will notice some green lines that are popping up on my chart, like this green line here. I have another green line here. I have another green line here. I have another green line here. And if you look at the numbers of all these green lines on this edge, you will see that they are all random numbers. You can see the first one here is 1.31000. The next one is 305000. The third one is 30000. Then why the last one here is 295000. Now, the difference between this line and this line, the measurement of this space in between it is always 50 pips. The same thing here, 50 pips. The same thing here, 50 pips. So they are 50 pips distant from each other. So now, psychology levels is very important in Forex. It's just like when you want to buy something in the market. For example, now, you want to buy, let me say fish. Let's say you want to buy catfish and they tell you that the catfish is 8,000 naira. Now, when you want to price it, you start pricing for something like, you can say, okay, let me pay 4,000. The person now tells you, okay, no, it's 7,005 last. Now you increase it more. It's okay, let me give you 6,000. Before you know, you say, okay, let me give you 6.5. You see, now those numbers you are calling are all random numbers. You cannot start pricing and say, let me give you 6.2, let me give you 6.1, let me give you 6.6. Some people price like that though, but it's unlikely to happen. You are most likely to um price at a random number. So the same thing applies to Forex too. In Forex, many things happens at these random figures. These random figures, this psychology level, these random figures that I call psychology level are levels that something unique normally happens. So we watch out for them. Sorry, I have a little cough. So now yesterday I looked at where the market is currently trending at. As you can see, it is trending from this side down to this side. Although yesterday it was not around this area yet. It was around this area, but I know it was a downtrend. So what I now did is I drew psychology levels around that area because I want to look out for it. Then now I changed my time frame to 4 hours time frame. Then I zoom in on the chart and look at Monday. This candle here, this candle you are seeing here, this candle you are seeing here, that is Monday candle. That's the first candle that came out on Monday. So the first two candles that came out on Monday, which is this one and this one, those are the ones I call my high and low of the week. My high and low of the week. That's what I call them. My high and low of the week. So what I now did is I I just drew a if you see this red line, I drew the red line at the highest point of that candle and the second line at the lowest point of the second candle. So that's I call those two lines my high and low of the week. So basically what that just means is that no matter what the market is doing, whenever it's coming, whenever it comes to that area, maybe around here, or it moves up to this area around here, I'll be looking out for a sell. So this week for GBP USD, I'll be looking more for a sell. That's what it just basically mean. So now, if that trade now comes to that cycle, that's my high and low of the week, that is one confluence, right? That is one confluence. So after drawing that on a 4 hour time frame, I now reduced my time frame now to 1 hour. I reduced my time frame to 1 hour. And when I reduce my time frame to 1 hour, look at it, I now notice that I notice that there are some tops around this area. There are some tops around this area. So I drew a trend line just straight down. Although when I drew this trend line, it was not like this. This was how it was. Let me adjust it. It was kind of something like this. It was kind of something like this. Good. So now when it was like this, the market was around this area. The market was around this area, right? It was around this area. So how did I know that it's going to sell from that area? What I now watch out for is how it's going to behave. Now I know that this red line here is my psychology, is my low of the week. That's the lowest point of the week. Then, if you also check too, this place is a zone. This place was a resistance zone, but since the market has crossed it below, whenever it's coming back up, that place now, that's why I drew this box here. That place now will now serve as my this place, it was a support zone, but around this area now it will now become a resistance zone. So now that is two confluence for me. My low of the week is corresponding with my previous support level. So that support level, I'm expecting it to change to a resistance level. So when it's now coming towards that side, that is two confluences now. Don't forget the red line, which is the low of the week, then my uh, support box, which is also corresponding with that low of the week. Now, I now reduce my time frame again to 15 minutes to check for my entries. So normally what I'm now going to be looking out for is weak rejection to be sure that this trade is a good one. You understand? I need to be sure that this trade is a good one. So what I now did is this. When it came into the box around this area for the first time, I did not drop the signal. If you check the Telegram channel, I did not drop the signal because it might just come here and just, plunge up. So I did not drop the signal. What I normally wait for is let it bounce off that zone first. When it bounces off that zone, that is to show that it is likely to continue going down. So what I now did is when it bounced off that zone, I now wait for it to come back to that zone again. I waited for it to come back to that zone again. That was when I now dropped the signal for a sell. So now I brought out my long levels. Okay, don't let me use that. Don't let me mess up the chart. So I entered around somewhere here. Now I dropped people 15 pip stop loss, which was somewhere around, let's say, here. But to be on a safer side, I'll not go more into that too because that information is just for the practical channel. But let me just give you a summary of what I normally do to be on a safer side. Let's say on this particular trade now, I'm expecting to reach, for example, I want to reach like, let's say, 50 cents. Sorry, $50, for example. When this trade comes to this area first, I will not reach the entire $50. This thing I'm telling you now is a big secret. Honestly, it's a very big secret. I'm not going to reach the entire $50 here because I don't know if the trade is going to, really bounce off from there. So what I'm going to do is this. I'm going to risk only 10 at that point. So when the trade comes to this point, instead of risking $50, I'm risking only $10 from this area. Then I will now look at how it's going to be. Now, you will observe that the trade now bounced off that place for the second time and is coming down. Now, I now drew a mini trend line. This was the trend line. This line here, this green line here is my trend line. This was the first bounce. This was the second bounce. this is the third bounce. And according to trend line rules, most times the fourth bounce is always the one that will break it. Most times is the fourth bounce. So what I now do is, remember, I'm already risking $10 here. I will now wait, let this trade break this trend line at this point. When it break this trend line, you can now see that that trend line that it break here correspond with one of my psychology level here. That's those round-up figures number that I'm telling you, those round-up numbers. That breakout of the trend line correspond with my psychology level here. So now when it broke that level here, what I now did is, that was when I now told you people to tighten your stop loss. I'm just telling you how me I basically trade it. You might have reached the entire $50 from here, but me, I'm telling you how it normally be. That's why my account is always preserved. Now I risk only $10 here. When it now break below here, it has shown me that okay, this psychology level there, it is more likely to continue coming down. Check out the confluence. First, this place has become my resistance zone. Second, it has formed me a double top. Is it a double top? I can call it a double top or an M pattern on a 15 minutes time frame. Then this candle here has also broken both my trend line and my psychology level. So this trade is bound to be short. So what I now did is, my stop loss that was initially here, I will now bring it to the recent high here. I reduced it. And since I entered around here and I'm reducing my stop loss here, this is a currency pair. So if you measure from year to year, I think it's just between, let me see, like just 1 pip or 2 pip. That's just it. So what I'm risking on that $10 now is just 2 pips. So it is at this point now that I will now risk my own $50 proper. It is at the point when I am now sure that this trade is going to go in my favor. That is when I'm going to risk what I initially planned to risk. Then I will now bring my stop loss. I will enter the $50 around here and bring my stop loss around here. That is the original trade for me now. So I have a $50 here that is now at risk free, and I have my main fee. Sorry, let me go over that again. I have a $10 here that I opened initially that is now risk free because I've tightened my stop loss, and I've opened another $50 position here with my stop loss is also around this area. Now I will now be waiting for the trade to go in my favor. Now the trade now keep plunging down. Now where am I even targeting for my TP? Normally I'm supposed to target this next psychology level. I'm supposed to be targeting this next psychology level, because whenever it breaks a psychology level, it is just ideal that before it start turning back, it will at least go straight down to the next psychology level. But to be on the safer side, I did not target that psychology level. This was where I target. I just target this area here. My previous low, that was where I just target, which was about 40 pips. So now what I now did is, as it now keep coming down, when it gave me 15 pips on profits for this one here, 15 pips or 10 pips, depending on how the chart pattern works. When it gives me 15 pips on that $50 that I am risking here, I will now bring my entire stop loss, all those stop loss that was here before, I secure break even here. So that means the signal here is secured and the signal here is secured. You see that? I have now break even. Both my $50 that I'm risking here, the stop loss is now here, so it's safe. The $10 I was risking here, the stop loss too is now here. Is that one too is safe, even on profit. So what I will now do is, I can now, maybe around that time, the trade is already here, almost at my TP level here. I can now decide to risk another $10. This time around, we are not going to risk big. The idea is, whatever you are risking at this level now, this level here now, you don't want it to be too big, so that the positions you have opened here and the position you have opened here will cover for any loss that might be incurred around this side. So let me come over that again. Your first entry should be conservative because you are not yet sure. Your second entry should be aggressive because now the trade is looking more decent. Then the third one should just be like, it's just like Jara. So it's just, just make it conservative too, just minimum lot size. Then as soon as you now get to this point or more, just take out your profits. Now you are going to be risking, you are going to be eating. Sorry. So that means you are going to be eating about you are going to be eating profit on this one here. You are going to be eating, sorry, excuse me. So you are going to be eating you are going to be eating profit on this one here, you are going to be eating profit on this one here, and you're also going to be eating profit on this one here. And if you check, everything you are risking is still within your risk capacity. Now, this strategy I'm dropping here is something that actually works very well both for gold and GBP. But I would advise you to use it more on GBP, because GBP, GBP, the risk on GBP, the volatility on GBP is not that high like gold. Gold can just start fluctuating, and it just mess everything up. So remember, when you are entering the trade, be conservative. Don't just enter with full force. The second side, when you've seen something tangible, maybe like a break of the psychology level or a trend line, you enter aggressive. Remember, you're still risking your $50 and the main money you want to risk. Then for the Jara, you can now go back to your conservative method and take your profit at this level. And that was exactly how I traded my own yesterday. And at the end of everything, I was able to go home with about 40 pips. But if you calculate it the way I said it now, you see that normally you are risking 15 to gain 40. That's supposed to give you like times 2, or maybe slightly above times 2 of what you were risking. But if you use this pattern I mentioned to you now, it will be more than times 2. It will be more than times 2. And since you are now sure, it will even make you to even want to risk even more than what you expect to risk. So that's basically how I traded the GBP USD signal yesterday. So today I'm waiting for GBP2 to form something reasonable for me, but I'm not seeing anything clear on the chart here. But now I'm now going back to my gold chart, on a 1 hour time frame. So I applied that psychology level thing on gold too, and I saw that it is working. In fact, on Monday, I didn't have been using this psychology level. Now on Monday, I would have dropped an analysis for a what did they call it, for a buy, and that buy would have gotten something like 300 and something pips. And this is it. I would have dropped a buy around here and would have take profit. One would be here, which is this recent high. So that would have given us like 300 sweet pips, over 300 pips. But no regrets though. That's why it's good to always do back testing. So how will I even drop the signal? You see that my zone, this zone here, is corresponding with one of the psychology level. Do you see that? So what I would have done is, since if you've been following my signal on practical channel before, you will notice that for gold, anytime the market is trending normally, we don't necessarily need to be waiting for all this W pattern, M pattern, although they confirms it more. But whenever it comes to a zone, it is more likely to just push immediately. So using that risk management skill that I taught you, that I mentioned on GBP, you can also apply it on gold. But gold will not be on 15 minutes, it will be on 5 minutes. Gold pips calculation is always high. So gold will be on 5 minutes, not 15 minutes. So what I would have done is, immediately this trade now tap into my psychology level and my zone, I would have risked low. I would have gone conservative, just open a trade, and my stop loss would have been in maybe the next psychology level, which is just 50 pips. You see it now. Then I will now bring out my trend line tools and try to see if there's any pattern that is forming. And in this case, I think I'm seeing a downtrend, a mini trend line here, which is around here. So what I will now be waiting for is a break of the trend line, and if possible, also a break of the psychology level. And that was what really happened. If you look at, let me zoom it. Okay, so if you look at it, this particular candle here broke the trend line, but am I really sure? The next candle confirmed it, and it broke the psychology level. So at this point, when it broke the psychology level, what I would have done is, remember, let's say I still wanted to risk $50. Remember my first entry, I'm risking like, let's say, $10, because I want to go conservative. I don't know if the trade will go in my favor. So I would have risked something like $10 around this area, and my stop loss obviously would have been on the next psychology level. So I would have put my entry around here. My stop loss would have been 50 pips, because I'm going conservative. Now, as soon as this thing break the trend line, I can decide to open another position here and put my stop loss in this recent low. The idea is this previous $10 now is now risk free, or the risk is now minimum because I've reduced my lot size. So what you now do is you open that you go aggressive now. Remember, the first entry will be conservative, next one is aggressive, next one will be conservative. So this is conservative now, which is that $10. Then the next one I'm going aggressive, I'm risking my $50. Then my stop loss will be around this area here. My stop loss will just be around this area here. This is my original trade. This one was just to test the market. Now I will now be waiting again. And the market now continue in that level. It starts consolidating around there, but eventually it broke to the upside. As soon as it break to this up price now, I'm now sure that yes, this market is in my favor. Like, I'm very, very sure. So remember, I have an open position of $10 around here. I have another position of $50 around here. So, and all my stop loss has been here. So when the market now goes up and even come to half of this, or even come and break this second psychology level, I can secure my stop loss to this area. So when I secure my stop loss to this area, remember, from here to around here is already running like 100 pips. The $50 I was risking around here to around this point is already running almost 100 pips too. So around this area now, I can now open another conservative trade, maybe like $10 again. So I was risking $10 around here, risking $50 around here. Now I'm risking another $10 around here, and all my stop loss is around here. So even if this one comes down and break me, which is unlikely to happen, the profit I'm going to make here and I'm going to make here will take out the loss I'm going to make here. The loss will be very, very insignificant. It does, even if I will see loss at all, because I'm already securing profit. Remember, I already have my position opened here, and my stop loss is already around here. So the profit of this one will cover for the minimum loss of this one, because this one is a big loss size, this one is a small loss size, and this one is a small loss size. So when I have that my three positions open, I will now be waiting to see what the market will now do. And eventually, you can see the market eventually comes to my take profit level, which was around here. But if it was somebody like me with that kind of pattern I've already used, I think I would have taken my profit around here, which is the psychology level before my TP. I would have run, because that's very, very okay for me. But we didn't trade that. I'm just doing like a kind of back testing for you people so that you can see how you can be taking trades, meaningful trades. So now, today, now, I think the same thing happened again. You can see that this one was on which day, sir? This one was on. Okay, this was today is Wednesday. Okay, this was today early morning around 4. That was when I was doing my back testing. Actually, I think I took this trade. Meaning, I just took this trade to test something, and I make some, tangible profit of it. So now, the next thing is today's trade, right? So I can now reduce my. If you had followed that same pattern to here, going conservative first, as soon as if you zoom, let me zoom. This one was not like a trend line. This one was more of a ranging market. You see, this is like a box here. It was ranging inside this box. As soon as you break this box here, you can open another position and maintain your stop loss around here. You see it, and go aggressive around this area. So that's how you trade it. So now, the next one I'm now waiting for now is today. So let me increase my time frame to like 1 hour. 1 hour time frame. And as you can see, the gold has surged high again. It has surged high around this area. So where is my likely zone? I think my likely zone is here, and it did not even form a wick on top. That's why I'm maintaining this line here. I'm using this line here as my previously resistance zone, and I'm expecting trade to come back here and use that zone now as a support zone. And if you watch it very well, it will correspond a little with my psychology level. So remember, when it comes to this level, I'll also update you on how the trade is going to be, how I'm going to take it. And for me, I will first go conservative before I now go aggressive. Then I will now repeat again with conservative, depending on how long or how far the TP1 is going to be. So that's basically how I'm looking at the market. I hope you learned something from the video. If you do, just drop a like on the video so that I can know that I'm communicating. Thank you.